Hello, Big Trends traders. This is Price Healy with your weekly stock market update for this Monday. It's March 30th, 2026. As we get ready to finish the quarter tomorrow, markets open higher. You can see the Dow still holding gains up 150, but the rest of the markets are headed lower. As you can see, Nasdaq down about 0.6%, S&P down 0.2, Russell 2000 down 1.4% on the smaller cap average. So we'll take a look at that. Volatility index actually down despite the sell down, but still hanging at 30, well above that 20 level. Look at the charts here. Start with the S&P. Of course, a lot of this is driven by oil prices. We want to look at oil as well. But you see the S&P has broken its 200-day. We talked about it last week that that's not the kind of pattern you want to buy the dip on. You can go back and compare it to last March and April. We just started to break and, of course, had that much worse leg down into the Liberation Day announcement from President Trump with his tariff initial proposal that he backed off of. But, bottom line is that that's what you risk, is that type of dislocation. Of course, if there's any comparison that might be encouraging, it's at the directional movement lines, which we key on a lot. The net negative line last April at the low got to 49.5, almost at 50 level. Usually 40 is extended, 50 is very extended. We got to 40 back here on March 20th, and then as of Friday got to 44. So we haven't hit maybe that last flush. If you're trying to pick out support points, we're into one right now around the 633 zone. That's about today's low. So we're kind of testing that, but it looks like if we undercut that, which I would expect, we get down towards that 620 big round level. And if that 620 level gets broken, you open the door towards 600-ish, maybe. See, there's a low down there. It's 593. But again, don't want to catch a falling knife. You got to be careful. And again, it's because of oil prices. So before we go to the other indexes, got to look at oil, and you see breaking out even more on USO. We mentioned last week that this pullback was likely a buy the dip as long as it didn't close under that low. It was still a bull retest and a bull trend in motion, testing back into these bands here at 106.5. Little bend but not break pattern, percent R retest, ADX bend but didn't violate that. 106. Now we're 127, 20 points higher on USO. That's the oil price ETF in just a week. So you see that's going to have a continued negative impact on consumers with higher prices at the pump. And of course, contractionary effects on the economy. Jay Powell, our Fed chair, said that he does not see a rate hike because of the oil shock. Of course, he's going to be out apparently as of May. So with Kevin Warsh coming in to replace him, but not an enviable spot to be entering for the new Fed chair in May. But we'll see how that plays out. But for now, the pressure is on the markets with the heat up continuing in oil prices. Of course, if you look at the other major averages, the tech-heavy Nasdaq underperforming, you see really got bashed, barely bounced, and continued to slash, and really sets in place a test down at this 550-ish level, which right now we're 559.5. So basically 560, not that much of a stretch to 560, and then we see where it goes from there. But of course, you see it's a pretty significant test, or undercut, I should say, of that 580 support line, which got tested that first time, but then now violated as of Thursday's close. And so, bottom line is that we shouldn't expect the president or anyone to bail out the market at this point until we get better technical signs that things have finally reached a peak. There too, the Qs traded up near 50, 47 on the DMI line, and then 42 on the DMI line. So not quite as extreme yet. But again, may get there. Of course, let's look at the volatility index, because, if you look at VIX, you usually want to see it staying under 20 in bull market conditions. And you see we broke out to 35. Then we came all the way back down and tested near 20 here. And you can see that since then, we've bounced all the way back up to the top of this recent range here, 32. It's about our upper big trends band, and that's right where we've tested the last couple of trading days. So we don't want to see a trending VIX. We have one right now, and that's something that's a little bit of a cautionary signal. So we start accelerating, especially through the mid-30s. You do open the door for a spike towards 50. And of course, we spiked briefly too on the tariff fears to 60, but of course never closed over 52 and a third. And so bottom line is that, just again, waiting for maybe that final panicky shoe to drop. We'll hope that it's not as dramatic, but sometimes it has to feel that way to get that sort of final flush of bullish sentiment. Although AAI, American Association of Individual Investors, week before last hit over 50% bears, which usually comes near the low. But again, day to day, not a timing measure, but hoping that we're getting towards the last end of this hard flush, needing that last little shakeout. We'll see. And of course, then we mentioned the Russell and how that was playing some catch up on the downside. That's now going to be its first close under the 200-day. It looks like. See, it held it on Friday, but now on the verge of breaking it here. So again, first breakage of that, and if we stay below it, you see it was a pretty steady march down for about a month, or actually a little more than a month, like 6 weeks through late February to early April last year. So again, not saying we're going to repeat the pattern, but at the same time saying be aware of it. And then of course I mentioned the Dow outperforming, but still it too has broken. So while it's up today, it's still broken. It's 200-day. See, all these have had bearish ADX trends, the green line on the bottom panel, and of course bearish for NR and CCI readings. In fact, a lot of them actually had CCI readings down to minus 300. Dow only got to minus 267, but the Qs and the S&P got over minus 300, which is quite extreme, and usually says that that's a pretty heavy selling pressure that's going to take at least some time to base build, if not possibly go lower still. So don't want to be too negative. At the same time, want to be appropriately hedged. We think gold should get back to being a hedge eventually, but right now you see it's still kind of going through this negative directional movement line cycle since the March low got violated just under 460. We talked about last week that opened the door to this quick sell-off to 400. 400, of course, the prior October last year high, another support level. And so for now, it's holding in that 400-ish zone. That low is 395, and the low last week at about 399. So 395 kind of needs to hold, although you see 200 days at 377 and rising. So again, just still kind of waiting for the next kind of all clear, but expecting gold to be a beneficiary of that. And then the bond market, with all the switch from a possible interest rate cut a month ago to now an interest rate hike being postured, although probably unlikely, see bonds have underperformed, and that means longer term rates are rising, adding additional pressure to the market to go with the oil pressure and gas price pressure that's happening. So you look across the major stocks, and it's pretty much of a who's who of prior big momentum leaders on the upside are getting bashed here. It's like a Western Digital down 8%, a Bloom Energy, just a lot of the high flyers. You see, there's basically like a risk off basic thing happening here where it looks like a flight to safety. And so you have to be paying attention to that. And maybe one of the last bastions that's been trying to hold up is Apple. And finally, it looks like Apple's undercutting its 200-day today. It's held up so well, but now starting to give it up a little bit, in addition to NVIDIA having undercut its 170 support and undercut the 200-day a week and change ago. A name like Palantir that we like to trade, you see, got up almost a perfect test up to its 200-day, just over 160, and then now headed back lower for now. So we did score on Tesla puts again for our Tesla option trader subscribers last week with another nice doubler. And so, or healthy profit at least. And bottom line is that you see it too got a test up last week to pop up to just under 400 and now rolling to a new short-term low. So again, these things are all bearish for now. That's not a reason to go and put your head in the sand to go into a cave. It's actually saying you need to have put options opportunities in addition to call opportunities to help hedge your overall portfolio. So definitely we expect to still trade more puts as trends head to the downside for now. And then, of course, when it turns, we'll be back the other way. But bottom line is that make sure you've got put option trades coming into your trading portfolio and help your investment results to stabilize. Just give us a call at 800 Big Trends or email us over at clientcare@bigtrends.com. Have a great trading week ahead. Remember, we're closed this Friday for Good Friday ahead of the Easter holiday on Sunday. Happy Easter, however you like to celebrate it. Spring is upon us. And so have a great holiday weekend as well. I'll see you again next Monday. Trade well and stay well.